The shutdown of the Strait of Hormuz is already taking a toll. Diesel and jet fuel prices are surging across Asia, Europe, and the Middle East. And as investors wait for the bombing of Iran to wind down, the real question is, how long will investors wait? Welcome back to Navlair Market Buzz. Today is Jason Bodner, the co-founder of MoneyFlows. Thank you so much, Jason, for joining us today.
It's always great to be here. Thanks for having me.
Jason has a new podcast called The MoneyFlows Show on YouTube. We have links down below. Check it out. It's growing fast.
Thank you. Yeah, it's exciting.
So, Jason, it looks like traders have moved to the sidelines. When do you think it will be safe to step back into the stock market?
Yeah, I think that's always the question that comes up in high volatility. Obviously, U.S. attacks on Iran, oil prices are spiking, software stocks are sinking, and it's just all over the place. You know, that's always a great question when volatility spikes. Obviously, U.S. invades Iran, oil prices are spiking, software stocks are sinking, everything's all over the place. But I just like to draw your attention a chart of fears plotted against the market since basically, I think it's 1900. What you'll notice right off the bat is that what looks like a huge issue at the time, turns into a small little blip. I mean, if you're looking over here at major calamities like World War II, the Great Depression obviously screams out. That was a big one. World War II, Vietnam War, JFK assassinated, AIDS crisis, Chernobyl, COVID. You look at all of them over the course of time, they all wash away. And they all end up turning out to be opportunities. And I personally think this one is no different. And we're also going to put on your screen a chart of actual returns that you can see quite clearly has a very positive forward returns. I don't think anyone should be getting out of the market. Traders, quick in and out. I totally get that. Maybe you want to sidestep risk, but for the long-term investor, I think opportunities abound.
So, Jason, I guess we got a couple of issues. We have Brent crude over $90 a barrel now. Apparently, the storage facilities around Saudi Arabia are filling up, and they're going to have to shut the wellheads if they can't get the boats going because, the Strait of Hormuz is closed right now. And even the President Trump offered to escort boats. The insurance companies don't want the boats going through the strait. So that's the big issue. And then apparently a lot of people are getting stranded. Okay, I guess the Dubai airport was hit, and I know there were some professional golfers that had to catch a private flight out of Oman to get out of Dubai. So this is escalating and really disrupting things. Diesel prices have gone through the roof, as have jet fuel prices. How are these geopolitical shocks going to last? I mean, are they going to last a month, a few weeks? What would you buy here? Because obviously there's a lot of pullbacks.
Yeah, great question. So I'm going to share on our screen. We have a macro strategist, Alec Young at MoneyFlows, who puts out some amazing stuff. I'm going to show you. He attempted to answer the number one question on investors' minds, what you just asked. When oil spikes, is it bad for the market? And 1 month, we have meager returns. This is historically going back since 1990. After crude oil rises 5% 2 days in a row or more. I mean, look at the forward returns, 3 months, 6 months, 12 months later. Basically, this tells me, and answer your question, Louis, we would have maybe 3 to 4 weeks of continued volatility. We're eventually going to get a resolution here with a new regime. Straits of Hormuz will open. I think Goldman Sachs put out research that they thought it would be open within 5 days and resume full capacity within a few weeks. So we view this as a very temporary shock. And in terms of what to buy, I'm really liking oversold growth areas that are getting unfairly punished, people fleeing risk and jumping towards oil and gold, which are doing phenomenally. I'm not taking anything away. But if all of a sudden we do get this resolution, you're going to see crude oil's prices fall. We're coming up on the spring, things thaw out. The demand for energy to heat homes is going to go down. So margin compression which is cyclical, as you've talked about many times, should happen in energy. And I would expect to see those stocks pull back a little bit and see more favor in these high growth areas that are unfairly punished right now, like software, technology, and discretionary.
So as you mentioned, software stocks have started rebounding after several rough weeks. Jason, is the market just oscillating and looking for bargains?
Yeah, we love to frame everything in the terms of data at MoneyFlows. I know, Louis, you've been doing this for decades, thinking that way, cutting emotion out of it. I think there's a real opportunity. We've already seen software stocks rebound. In fact, a couple of weeks ago, I was buying IGV myself for my kids because the narrative, of course, is that AI is coming for your jobs, coming for every software company, going to take over everything. And software stocks got absolutely killed. Since the low, I think, was around February 23rd, if I'm not mistaken. IGV is up almost 12%. And we're seeing this massive rally because, people still got to do their taxes on software platforms. People still use spreadsheets. It's not like next month everyone's going to abandon every single software license they've been using for 10 years to switch suddenly to Claude. Now, that's not to, negate what AI is going to bring to the table, but I think there are tremendous opportunities here. And you cited ServiceNow, Intuit. There are Microsoft, tremendous software companies unfairly punished with terrific fundamentals that I see opportunity. So I don't think it's just an oscillation. I think it was a great excuse to take profits on a multi-year trade in software. And now you're seeing buyers step in because the thing's been straight up for almost a week.
I would add that I sold a stock a couple months ago called Guidewire, and there was nothing wrong with fundamentally. It was just a very weak sector, and it just posted a 52.5% surprise, and it is going higher with the rest of the software stocks. That's a good sign that sector is going to regroup.
Yeah, and I think I'd add a study that we did that shows the forward returns of IGV when the constituents of the index, it's a basket of software stock, when 15% of those stocks are above their 200-day moving average, 15% or more, the forward returns of IGV are tremendous. 1 month, it's kind of muted up 3.7%, 63% of the time. This is going back through history, starting in 2006. So we're almost, we're 20 years here. I think the important thing here is 6 months later, 71% of the time, IGV is up 16%. 12 months later, 92% of the time, it's up 33.6%. And here's the kicker, people. 2 years later, if you have 2 years to wait, 100% of the time, IGV is up 69%. So odds are heavily in your favor that this is not an oscillation, that this is an investment.
Jason, I've noticed the Nasdaq is showing a lot more strength than the Dow Industrials. I assume that's due to the software rebound. And do you have any other hot sectors you see they're about to perk up?
Yeah, I really think tech is still a great place, right? NVIDIA hasn't gone anywhere for the better part of a year, which is kind of, in the past 6 months, that's what we're seeing, that S&P is being held back by the largest growth engine in the market. And that's kind of an arbiter for technology in general. We've seen semiconductors explode since the beginning of the year and software stocks tank. So you get that flat action. But now it's starting to rebound because we just talked about software is catching a little bit of a bid. So I want to continue harping on that opportunity because I think technology, and to your question, discretionary are the two engines of a bull market. If we have both those things firing, everything else can sort of, be midland and still have indexes rising and people making money. And discretionary is a great example of people having expanded income to go spend in the market. We've seen some outflows in discretionary here and a slowing of inflows. But the moment we get resolution in Iran, with now the Fed chair Warsh confirmed, he's going to come in and start cutting rates. And I personally believe Trump is not going to put someone in who's intentionally going to go against him, despite what the news headlines say. We're going to get lower rates. We're going to get a resolution on volatility. We're going to see markets rise sharply. And I think discretionary is a great place to shop for the next rally.
Jason, since you live in Boca Raton, are your neighbors freaking out that their 11% yields on private credit may not
last much longer?
Well, in Boca Raton, we definitely have a older, well-to-do contingency here that rely on high yields. But I think I would point out, when private credit is under fire like it is now, I have a friend at Blue Owl who's involved in investor relations for their real assets division. They manage $76 billion. I reached out to him right away. I was like, what's the deal? Are you guys feeling the burn? And his answer, of course, defending the firm was more like, anybody listening knows what we're doing, and no, we're not feeling the burn, and no, I'm not worried. So, that's an insider's view. Take it for what it's worth. But Louis, I know you've been talking about the private credit bubble being the next one to burst, for years now. So I think when yields come into question and people are worried about those high yields, especially in a high volatility environment, I'd like to put up a chart that shows dividend stocks have more upside with less risk in volatile conditions. And what you're looking at here is the dividend payers' average returns versus their annual volatility. So you get the highest average annual returns with the lowest volatility versus non-dividend payers seeing the highest volatility. And this kind of makes sense, right? Growth stocks are going to bounce around and you're going to get more growth and better returns potentially. But this is telling you during periods of volatility, people want dividends. And we have a few other charts here that basically show dividend payers versus non-dividend payers in corrections do exceedingly well. So what does that tell us? If private credit's under pressure and their yields are going to potentially be collapsing and people are trying to pull their money out, where are they going to put it? They're going to put it into dividend stocks, I believe. So I think that's a great place to look for opportunity now while yields are still relatively low, because when everybody buys them, the yields are going to compress.
Yeah, I would agree with you. And I think the silver lining, if there is an ongoing private credit crisis, obviously they're all being hit with redemptions right now. I guess the silver lining is the Fed might have to step up and cut rates faster. So, because that would help the entire industry. So we'll see. But yeah, dividend stocks are off to a good start this year.
What did the February payroll and retail sales report signal about the economy?
Well, the February payroll report was a disaster. It was probably weather related and strike related, because Kaiser Healthcare was on strike out west, and there were 28,000 healthcare jobs lost. I believe we lost about 12,000 construction jobs. Obviously, it's kind of hard to go to the construction site when you have all those horrendous winds that the second big snowstorm in the Northeast had, and also you had all the ice and everything. So I think some of this is weather related, but the big news was the downward revisions the past 2 months. So here's the problem with payroll. It has fallen 5 out of the last 9 months, including 2 out of the last 3 months. So Christopher Waller was expecting a bad report. He's the one that went on Bloomberg some time ago, said there's going to be downward revisions. He foresaw that. This brings up the possibility of a March rate cut. Usually they don't cut when there's a Fed chair change, but they might have to if the data tells them. The other thing is the retail sales were weak. They were down 0.2%. If you back out autos and gasoline, they were up 0.3%. But there's no doubt, and this is January retail sales, by the way, that the government data is still behind because of the shutdown. But retail sales have been weak for the last couple months. So I think we got to be careful here. And I think the Fed might want to cut, but they're definitely cutting in May. Kashari, the Minneapolis Fed guy, said that he was open to 2 cuts this year. So I wouldn't say he's a hawk, but he's more neutral. And if he's going to agree to 2 cuts, that would be great.
Yeah, I think, this payroll data disappointing and trending downward. Also, you layer in this recent news of Jack Dorsey's company cutting basically half his workforce, 5,000 people cutting. And then you introduce the AI fears that, it's really going to contract the job force. I saw another announcement today expecting significant layoffs. These things tend to come in waves, so it's probably going to get worse before it gets better. But that, for longer term investors, does put pressure on the Fed to cut rates and sort of quell nerves, which is good, again, for technology and discretionary stocks. Counterintuitively, because you think, if everyone's losing their job, no one's going to be buying discretionary stuff. But I do think we're going to see more easing from the Fed.
So we saw stronger than expected productivity gains. What does that mean for GDP growth?
That means they're going to probably revise fourth quarter GDP higher, and that means a lot of our GDP growth is going to be tied to productivity. This is what Kevin Warsh, our new Fed chairman, has been talking about. Productivity gains from all the energy exports that'll help shrink the trade deficit. All that bodes well for robust GDP growth. We won't hit 5% in the first quarter, but we could hit it in the second quarter, and I think we'll sustain 5+ percent GDP growth for the rest of the year. It's also become very obvious that the U.S. is an oasis around the world. While China and Europe and a lot of folks in the Middle East are having issues because the war is disrupting the energy production, it doesn't bother us at all. We do have to pay higher prices at the pump, but at least we don't have any shortages like they do in other parts of the world.
I do agree with you, Louis. And also we have other tailwinds for GDP growth that don't show up necessarily in the headlines. You have a Trump administration that's been removing regulation and encouraging energy production, which should work its way into the GDP growth. Like you agree, we should see GDP growth in the higher percentages. But let's not discount AI is the big bad wolf of the market these days, but also it should significantly increase productivity. And I'm not saying we should sacrifice people's jobs. If there aren't significant cuts in the space, AI should enhance people's jobs, enhance people's ability as companies to make money and offer new products and services, which should also expand GDP growth. So, I think it's a double-edged sword with AI, but if you layer that in there, there's another additional tailwind for GDP growth.
So Jason, to wrap up, what are your favorite stock picks right now?
Yeah, let's do it. One of my top picks right now is Howmet. This is a global provider of engineered solutions. So this is a company that has the aerospace and defense exposure. You can see up here, it's got a great score. We're looking usually in the 70 to 85 range. So this is right in the sweet spot. Technically very strong, fundamentally very strong. You can see all these inflows lifting this stock higher. It's got great sales and earnings growth, and its estimated and forward revisions continue to be great. So this is a great one. HWM. I also like Intuit is an interesting one. This is one of those that have been under fire with the software space. It scores weak in technicals, but very strong in fundamentals. Full disclosure, I own this stock. I've owned this stock for a long time. I made allusions to people still needing to do their taxes. Well, guess what? It's tax season. I don't think anyone's using Claude to do their taxes right now. Seen a ton of outflows under pressure. This is a prior outlier. We have great sales and earnings growth, strong profitability, 20.5%, manageable debt. It's trading at a reasonable PE. I like Intuit. Let's move on to another company that I've owned for a very long time, Lam Research. This is the company that makes the equipment to make chips. And as we all know right now, there's a global chip shortage. There's a backlog of orders. People are desperate to get SRAM, DRAM. It's all a really squeezed space. So this company is continuing to do well. Strong technicals, strong fundamentals, see all these inflows. That was part of that big semiconductor surge in the beginning of the year. We pulled back a little, offers a good opportunity. Again, I own it. 1 and 3 year sales growth are excellent. Great profit margin at 29%, and their forward looks great. And last but not least is the Lord of the Jungle, the King of the Jungle, NVIDIA. It almost needs no further explanation, but they are at the global center of the AI surge, chip demand. They make the best chips. They can't supply them fast enough. They have the best margin expansion in the business. Their fundamentals are a huge 87.5%. Like we discussed, the stock kind of went nowhere. I fully expect that to pick up soon. You got a fleet of goods across the board. 1 and 3 year sales and earnings growth are phenomenal. An excellent profit margin, hardly any debt, trading at a pretty reasonable PE of 22 For a $4.5 trillion company, that's phenomenal. So I love NVIDIA.
And Dad, would you like to share what your favorite stock picks are right now?
Well, I would, but Jason just stole two of mine, which was Helmet Aerospace, which we've been talking about in previous episodes, and of course NVIDIA, which we talked about a lot. But I think folks should know that the gold stocks are great buys right now. The safest one is KGC, King Cross Gold, but we do recommend over 20 gold stocks. And so gold prices have finally started to settle down just a tad. And so now it's a great opportunity. Gold will continue to go higher. It'll be $10,000 an ounce by the end of the decade. I wrote an article, Market Watch, on that. Yardini's calling for that. And the main reason is the central banks have to keep buying gold because they're losing credibility around the world.
Perfect. Well, thank you so much, Jason, for joining us today, and thank you so much for answering all my questions. All of Jason's links and his YouTube channel will be in the description below, but we'll see you this Wednesday for a new video.